Okay. So today we're going to be talking about depreciation. Depreciation, you may have heard of little bits and pieces here and there when it comes to accounting. It is very, 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 very crucial that you understand this concept because it is definitely something that you will encounter, especially in accounting. It's going to be one of those adjustment entries that you need to know how to do at the lowest level of accounting. Okay. Now, first off, let's go ahead and talk about what depreciation even is. So, depreciation is going to be some kind of methodology that we've, adapted, especially when we make purchases of fixed assets. Okay, so again, let's make sure that you understand that depreciation is directly correlated to only fixed assets. Okay, so anything that's a property, plant, or equipment. So, what does that even mean? Well, as you guys know, right? When we make purchases of our fixed assets, what happens over time when you utilize the item? What happens when you use the item?
It loses value.
It loses value, but what else happens too? It just, if it's a machine, it dies, right? It reaches a certain threshold or a capacity that allows the machine to no longer function anymore. So, with that given idea, we need to find some way to spend or to express that we're using the item and that it's not going to reflect its value over time, right? Especially what they say, especially if, let's say, you do go ahead and you buy a printer, for example, right? And then you used it for like maybe a couple years, and then you go place it back on the market. Do you think you can expect to sell it for the same exact price that you purchased it originally?
No.
No. No, because you first off, you use the product. The machine has been tainted, right? The metal in there has been used. It's been worn out. So this is what depreciation does. It's a way for us to be able to find some kind of way to demonstrate or to show that we're using or spending the product or or the equipment in order to even produce a product for the company. So with that being said, now this you have to understand this as well. With the rules of gap, we can't technically assume that the our item or our equipment is actually losing value over time. Depreciation is the only exception and in regards to that because in reality, you cannot purchase an equipment and be able to sell it for the exact same price. However, with the given assumption um, of depreciation, we can assume that the minute that we do sell our or get rid of our equipment, whether we sell it to the public, we can assume that it's going to lose its value. So that way, when we do that, we're going to take a loss there. Okay, but in of course, we also have to know that when we're dealing with historical costs, we can only record it the day that we purchase it, and the day that we sell it is when we actually recognize that we actually received a loss. So, with that being said, we have to understand a few rules here as well. Okay, so depreciation, okay, is going to be something that's going to be for fixed assets, and this is going to be called a non cash expenditure or a non cash expense. All right, it's a it's going to be something that you guys need to know, especially because in reality, are we actually when we actually journalize this, are we actually spending money to get rid of our item or to reflect that we've used the item? Okay, and you'll see it more prevalent when we do our example. Okay, so if we bought a $10,000 machine, and we're trying to record our transaction for the depreciation, can we actually say, I'm actually going to spend $2,000 to reflect that I've used this machine? No, you're not going to spend an additional $2,000. So the assumption here is we're actually transferring money that is already been spent to make a purchase of our items, and we're going to recategorize them, or in this case, transfer them over to another account. That's exactly what we're doing. Okay. So, with that being said, we need to understand that it does lose value over time, and especially for fixed assets, right? You can't expect a fixed asset to withstand a long lifetime. Okay, so with that being said, here are a few examples, right? Especially with technology. You have computers, you have furniture, you have trucks, right? Vehicles, you have buildings, okay? Now, here's one thing that you need to know, and it's also applied to property management as well. Land does not, land is the only tangible asset that never depreciates, okay? Now, in terms of when we go further or on into actually truly understanding and mastering accounting, you're gonna learn that land actually it depletes. Okay, so there's a few different terminologies. It's similar to depreciation, but depleting is completely different. So when we talk about lands, right, we know that land it erodes, right? Or we put buildings on top of it, or some cases we mined oil out of it. When you are mining oil out of it, you're actually essentially taking value out from the land. So yes, there is a way for us to be able to calculate how much that is, but in this case, that is actually advanced level accounting that we actually see depletion actually being physically worked into. So again, for this particular class, all I want you to know is that land can never be depreciated. Okay, and that holds true for property management as well, right? Usually, land it gains, right? It gains value over time. But in this case, I need you to understand that for accounting, accounting 101, land can never be depreciated. Okay. So let's go ahead and talk about what are the aspects and what defines depreciation. So we talked about GAAP. GAAP, there are two rules that actually govern this. And again, we talked about historical cost. We learned that when you acquire any fixed assets, right, you're going to report it as the moment that you purchased it at historical cost or at current fair market value. And you can never, ever assume, or you can never, ever place invisible money. You cannot recognize a gain or a loss until you sell the item. All right. And again, fixed assets can only be increased in value. All right. But they can also be also reevaluated at the end of its life as well. Again, that's also another advanced accounting that, of course, because we know it's true. Even though you do look at historical cost, right? We have appraisals, right? You can always test or claim to revalue either your land, your equipment, or whatever it is. And how you do that is you do fixtures, right? You do maintenance on your items. Now, this section, I believe it is in your reading. So I'm not going to test you on that because that's actually advanced level of accounting. But just for now, just know that with this, you are able to revalue your assets and you're also able to, extend a life. But in this concept, we're only assuming that there's only one way and only one way only, okay? And of course, matching principle, right? If we purchase a $10,000 machine, you can assume at the end of its life, which we'll talk about soon, at the end of its life, it better be zero. And then for your depreciation expense, it should reflect exactly $10,000. Okay? So matching principle plays a huge role in this exact one. Okay? So let's go ahead and talk about the components of depreciation. There are 5 total components that you need to know for in order for you to complete depreciation. Okay. First off, you need to know the total cost of the asset. And each one I'll explain in each slide after this. All right. Second thing you need to know is you need to know the estimated either useful life or expected use for production. And because today we're talking about units of production, we're going to take a look at the first one, which is the expected use for to produce the items. Okay. Third is going to be a salvage value, or also known as a residual value. Those two words can be used interchangeably. It just means at the end of its life, does it have some kind of value? Okay. Fourth, you need to know the date of when you placed your asset into service. Okay, this is very, very, very important. And then lastly, the fifth thing you need to know is which depreciation method are you going to use? Okay, so let's go ahead and dive into component number 1, the cost of an asset. We've spoken this before. It's very similar to acquiring inventory, right? You're going to add up every single cost it takes to get the asset to the store. But not only that, the most important thing is to get ready for service. Okay? As in, I may buy my fixed asset, right? But if I need to add any other things, any fixtures or any maintenance, or let's say I need to build a platform for it, that is going to be all included in the cost of the asset. Okay, so again, the main quote here is that it is every cost to get the asset to the store, but most importantly, everything in order to get it ready for service. All right, so these costs can include obviously the selling price, sales tax, any product fees, so any additional fees that have to be tacked on there, any shipping and handling, any training that needs to again to be used in order to understand how to use the product, and of course installation fees. So if you need to install it, that's all going to be included to the cost of the fixed asset. Okay. Component number 2. Now, there are 2 things that you need to know, right? There's a GAAP version and there's the accountant version. All right. Let's talk about GAAP first, and then we'll go ahead and talk about the sole proprietor, right? So we talked about salvage value and or we're going to talk about salvage value and an estimated useful life. Now, for the rules of GAAP, especially for corporations, they want to make sure that you try and not to fraud the government, especially when it comes to owning assets. Because for most cases, right, a lot of corporations, they'll take the easy way out and say, oh, this asset is going to last me forever. And as they say that, it just, and they never write it off at the end of the day, so their assets are always going to be reflecting as over. Okay, but in this case, GAAP says no, you have to go by these guidelines. Okay, so there is some type of Blue Kelly book out there for all fixed assets. Okay, so the rule is going to be the 3, 7, and 9 or 11 rule. I didn't mention the 9 and 11 because that's for buildings. Okay, buildings can either be depreciated either at 9 years or 11 years. But for this case, I want you to only know two numbers, 7 and 5. 5 are typically for any type of electronic, any type of mostly it's mostly electronics. Where your 7 years are going to be something for like machinery, or furniture, or even trucks. They fall under the 7-year rule. So vehicles. Now, understanding that GAAP is going to be governing this for this one, that means any to business type of organization that is not a sole proprietor must follow the rules of GAAP. So that means, again, they need to go ahead and look up that Blue Kelly book to determine how much their useful life is. Okay, now here's a little fun fact here. If you did not know this, your useful life is actually written on the manufacturing boxes. It's written in small print. If you ever researched it or looked at it, if you buy a printer, on the very back of its label, it will tell you how long its life is. It will say that this printer can should last you up to at least 500,000 prints. That is going to be a useful life. Okay, but in this kind of case, a lot of people don't know that. They just assume and go for the Blue Kelly book. Yes. So again, there is a book out there. So the rule is you either follow 5 or 7 in this case. All right. And then we talked about a salvage value. Okay, sorry. Let's go back to a useful life. What is a useful life? I didn't even mention what a useful life is. A useful life basically determines how long the asset's going to live for. Or in this case, how long it's going to be able to produce a product for you. So take a printer, for instance, right? Printers can usually last a long time. But if you are the kind of person that always start print out, you're printing 1,000 pages every single day, you can obviously imagine how much wear and tear you're putting on that machine. It will start printing slowly. It will run out of ink. The wheels start to get rusty, or the ink starts to splatter everywhere. That just happens. That's just a common thing that happens. It's a wear and tear. And that's exactly what a useful life means. It means that this is what the ideal, or this is exactly how long the asset can produce a product for, or can, or what do you call it? That's how long that they can have a life for. All right. So that is what that is. Now, of course, with salvage value, we talked about this too. At the end of its life, after it's been gone through so much, salvage value is going to determine does it hold a value at the end of it? Now, a perfect example is going to be a truck, right? A vehicle. We know out there that trucks or vehicles, they last forever as long as you maintain it. Okay. Now, of course, with 7 years, that's gonna be after 7 years, your car's got the wear and tear. If you haven't maintained it, then obviously your wheels are used. Your brakes are kind of they're not as strong as before. Your things like that kind of factor when it comes into cars, right? And at the end of its life, it's definitely going to hold a value because that's when we sell it. You're obviously going to go ahead and use the Blue Kelly book, and it's going to hold some kind of value at the end of its useful life. You could still use it, but the only problem is that you have to add extra costs such as maintenance, oil changes, annual routines. You need to go get your cars or your wheels rotated. Whatever it is, you need to add more money to this car in order to extend its life or to also give the car value. Okay? But with the rules of GAAP and IRS, they tell you that all fixed assets will not have a salvage at the end of its useful life. Meaning you need to make it zero. As in, you got a car, okay? The useful life is 7 years. That means it's at the end of 7 years, it's worth nothing. Okay? So that is what corporations, all corporations must follow this guideline because again, we can say I bought $100,000 car. It's still going to be $100,000 for the next 20 years. No. No. And that's exactly why we have the rules of GAAP to kind of say no, you cannot do that. But sole proprietors, they actually get a little more leniency when it comes to being able to determine the estimated useful life as well as a salvage value. Okay, so with sole proprietors, because they're so small, right? They kind of need these kind of extra helping hands and whatnot. They can't afford new assets every 5 years. Okay, so so this is one of the things that you need to understand. As a sole proprietor, you have full range of creating the estimated useful life. Okay, managers can determine it. Now, I can buy a printer and say that's going to last me 20 years. Absolutely not. It's going to have to also, you're going to have to do extensive research as well when it comes to determining a useful life. Because yes, in our reality, our printers, they can last anywhere up to 20 years or 10 years max. Because, we also have to assume that as a sole proprietor, we may not need to print that much, right? We're our small business. We're not supposed to utilize our items or our fixed items as much as a grander scale as a corporation would. So the assumption here is with research and with understanding how often you use your asset or your equipment, whatever it is, right? Then we're allowed to get away with being able to determine our own estimated useful life. Okay. Same thing goes with salvage value, right? Because we can, and we have to do research with this. Because we can, they will allow us to do as well. So again, if we have a car, right, we can easily say it's going to, at the end of 30 years, it should last us, or it should give us a value of at least $5,000. Okay, so under GAAP, anybody that's a corporation or that's not a sole proprietor We must follow the rules of the 5-7 rule. Okay? And there is no salvage value. For sole proprietors, we can create the estimated useful life and we can also create a salvage value. Okay? All right. So, again, step number 3 or component number 3. Actually, we're on component number 4 now since 2 and 3 were explained in one slide. So, the date of when you place it in service is going to be absolutely very important, especially when you depreciate your fixed assets. So, when we understand this, you need to understand that when we place it into the service, that's the day that you start depreciating it. Okay? Now, we also have to understand that we have to treat our fixed assets just like they are our baby, right? The day it was born is going to be the day that you count how old it is, right? So that's exactly the same concept that's going to apply here. The day that you place it in service is going to be the day you start depreciating it. So when we talk about how old it is and how many years it's been and apply it to its useful life, if my printer can only last me 5 years, so if I started to place it in December, right? That means 5 years in from starting from December and ending all the way to November of the 5th year. That's how I'm going to depreciate my asset. I'm not going to depreciate right from January all the way to December and assuming that's one whole year. No, that's not how this works. There are a few rules and concepts here too. When you actually depreciate it. So, the date, again, the actual date. So, if it falls anywhere between the first 15 days, so the first all the way to the 15th, you're going to need to depreciate that month because more than half of the month has already been it's been used. Okay? But if let's say you put it into service after either the 15th or anytime between the 15th to the 30/31st, you can assume that's the very last of that's the very like last week of the month. That's nothing. Okay? You haven't used the item that much. So in that case, they allow you to depreciate it the following month after that. So understand this. All right? So if you've placed it into service anywhere between the 1st and the 15th, your assumption is you've already are using it at least 75% of the time or at least 50% of the time. Then you need to depreciate that month. If you don't and you place it anytime after the 16th through the 30th or the 31st, then you can assume you didn't really use it much. You used less than 50% of it. Then you can go ahead and depreciate it the following month. Okay? Does this concept make any sense? Okay?
Yeah, it makes sense.
Okay. All right. So again, when we talk about understanding and knowing this is very important because again, you can purchase your asset, but when you place it into service, you can place it into service anytime you want. Whether it's in the middle of the year, whether it's in August, whether it's in December, you can do it whenever you want because the assumption is here we have to understand that when we depreciate our assets, it's based on its useful life and it's based on, like we've mentioned before, the day that you place in service is going to be the day that you start depreciating it. So with that concept, that's where partial years is actually going to come into play because most cases depreciation is definitely going to happen. It's an adjustment entry, so it's going to either happen at the end of the year or it's going to happen at the end of every month. All right. I've never seen any daily depreciation unless it is something like a vehicle. Okay. So as you guys know, right? Vehicles, right? When you purchase it, when do you start depreciating it? The day you drive off the parking lot. Okay? So now don't confuse this. Just because you purchase the item, that does not mean that's the date you're going to use, that's the date that you're going to actually use it. Okay? But most cases, you always want to double check and confirm. You don't want to buy a product, right, or a piece of equipment, especially if it's going to be used into your operating core of your business. You don't want to wait till 3 months later to test to see if it works. Okay, so the assumption is usually, oftentimes, when you buy it, you want to turn it on to see if to make sure it works. So the assumption is, most cases, it's better that you depreciate the day that you purchase it. Okay. But just make sure that those are two separate things. The day that you purchase and the day that you place into services is going to be two different dates. Okay. All right. Last but not least, depreciation methods. Okay. As you can see, there are a whole bunch of depreciation methods out there. Okay. Even if you go ahead and open up any accounting book, there's about 6 or 7 or even 8 of them that exist in accounting right now. But for most cases, I do not have the time to teach it, nor do I find it very relevant. So I'm only going to teach you three depreciation methods. Okay. We're going to talk about the first one. I'm going to go over all of them. So obviously the first one's going to be the activity-based method, or also known as the units of production, which is the one that we're going to be talking about today. And this one's going to be based on, again, activity. How much can it produce? All right. I'll explain more about it in a second. So when we talk about bases, or a base, right? In this case, units of production is going to be based on how much an item can produce. So if, for example, a machine has capacity, you're going to understand that is going to be that's going to be how you depreciate it. It's based on how much it can produce. Okay? Where straight line is going to be the most common one that you'll ever see, and it's going to be the one that most corporations use, because it is the easiest way to go ahead and calculate, and it is also the quickest way, and also it also doesn't leave much room for fraud. Okay, so straight line's pretty straightforward. Think about it. Straight line. When you draw a graph and you draw a straight line, it's consistent, meaning every single month you're going to depreciate, it's going to be the same value. Okay? It's going in a straight line. All right, and we'll explain more about that when this is going to be on Thursday. We're going to take a look at straight line on Thursday. Some of the years is actually one of I actually like some of the years. It's one of my favorite depreciations, but of course in this in this class I don't have the time to teach it, just because, again, some of the years can make sense to you, but it's not a common one that many companies use. Some of the years is going to be taking, obviously, the sum of the years of that you use it, and from there you're going it. Anyways, I don't need to explain it because I'm not going to teach it, but if you do want to know more about it, you can definitely go ahead and research this. Okay, it's in all accounting books right now. Okay, Another common one, and I actually think that this is actually most commonly used as well, is going to be the accelerated, or also known as double declining. Now, this one is definitely going to be applied more towards technology, okay? Especially technology, right? And how accelerated or double declining actually works is it's going to be based on how often you use the equipment. All right. So that's also one of the more important ones. Other ones that we do that do exist is going to be group and composite, as well as hybrid combination methods. So again, those are again combinations, just a mix between the different methods. But yes, for this class, you're only going to be learning 3 and 3 only. All right. And it says IRS only uses the straight line because it's how easy it is, and they're the more common ones. Okay. So let's go ahead and dive into our first one. Any questions on the 5 components? Okay. It will make more sense when we dive into our example, because I'm going to show you how you apply all 5 concepts right here. Okay? Or all 5 components. Okay? So here we are. We are at activity-based method, also known as units of production. So as I've mentioned before, activity-based is going to be, again, it's going to be depreciation that is based on how the machine, or whatever the asset is, how much it can produce an item. Okay, so this one's going to be more common for the items that, for example, machinery. If you are producing a product for your company, this is very important, because there's always going to be wear and tear. There's always going to be things, right? Our way that we're going to depreciate it or measure how we use the item is going to be based on the numbers that the machine can produce. Okay, so here are the formulas I've been talking to you guys about that you guys need to memorize. Okay, in this case, just use the worksheets. So the first thing that we're going to be looking at is calculating the depreciation basis. Depreciation basis is going to be the cost of the asset minus the salvage value. Okay. Then we're going to be looking at a per unit rate. A per unit rate is going to be depreciation basis divided by the total number of units that it can produce. Okay, so as we remember, right, you have either or. You have either the number of units that a machine can produce, or you have a useful life. In this case, I'm looking at the number of units it can produce in grand total. Okay? And then you have depreciation expense, which is going to be the number of units that were produced that year times the rate, okay, or the per unit rate. And then accumulated depreciation is going to be your previous year's accumulated depreciation plus your current year's depreciation expense. Okay? And then lastly, we also need to know what is our potential book value when we actually sell off a machine. What is its value supposed to be reflecting? So your book value is going to be the original cost of the asset minus the accumulated depreciation. Okay? So all these formulas, okay, we're going to apply them one at a time. All right? So let's go ahead and dive into our example right here. We have example number 1, record the depreciation for the first year. Notice this. I want depreciation for the first year. Okay? And then here it says there was 2,100 units produced that year. Okay, so let's go ahead and review this information because this is something that you're going to be receiving, and this is the information that you're collecting. The 5 components, right? First off, your first one is what is your total cost of your asset? In this case, it's going to be $15,000. Okay? Second thing is your estimated useful life. In this case, my total number that this machine can produce is 10,000 units. So number of units produced is going to be 10,000. Okay? Component number 3. Do you have a salvage value? Yes, you do, because we are going to be practicing sole proprietor, but again, we can use corporation, we can use GAP's rules as well. In this case, I have a salvage value of 2,500. Number 4, when did you place it into service? I placed it in service on January. That means I'm going to start depreciating as of January. Okay? And then lastly, what is my depreciation method? That's number 5, which is we are only learning one at a time. So this is units of production. Okay, so now that I've applied all my 5 components, now I can start plugging in all my information because you need all 5 components in order to go ahead and plug in your numbers into your formula. So the first thing here is you can see my chart right here. I have my first year. I have that I produced so far 2,100 out of the 10,000 that it can produce. Okay? So first thing is I'm going to solve for my depreciation basis. So again, my depreciation basis is going to be my cost of the asset minus my salvage value. So what is that?
15,000 minus 2,500.
Which gives me what?
12,500.
12,500. Good. Now, next step says, let's solve the per unit rate. So again, my per unit rate is going to be my depreciation basis divided by the total estimated number of units that it can produce. So, which number am I going to use?
12,500.
Okay, good.
And then 10,000. 10,000.
And the 10,000, good. All right. Oftentimes, my students, they automatically look at the total number that they produced that year. Wrong. It's not that. It's the total number that the machine can produce. So in this case, what is 12,500? What is 12,500 divided by 10,000?
125.
Good. Now, you can utilize this as a per unit rate because it's by dollar value. It's going to cost me $1.25 for every item I produce. So let's go ahead and solve for the depreciation expense. So the depreciation expense is going to be the number of units produced that year multiplied by the rate. So what is the numbers?
2,100 times $1.25.
Which gives you a total of what?
2,625.
2625. Good. And now, what is my accumulated depreciation? So it's going to be your previous years plus your current expense. 2,625. Okay, good. Because there is no previous year. You're starting depreciation for the first time. So that's 0. Plus the current depreciation expense, which is the 2,625. So therefore, my accumulated depreciation is 2,625. Last but not least, we need to solve for the book value. What is the value that it holds now as of this after a year has gone by? So in this case, it's going to be your total cost of the asset minus your accumulated depreciation. So what is
So that would be 15,000 minus 2625.
Correct.
Comes to 12,375.
12,375. Good. Good. See? So, like I said, it's a lot of information, but it's an easy concept to apply. All right? Everything you're doing now, so now let's go ahead and do this example right here. If I have, for my second year, I have a total of 2,000 units that were produced. So what is going to be my depreciation basis, my per unit rate, and my expense, and the rest of the answers? Okay.
So it would be 15,000
15,000,
minus 2,000.
2,500.
Yes.
Yeah, the depreciation basis wouldn't change. It'd be 12,500.
Yeah.
Perfect. Good. What about the rate?
Nope, that should stay the same also.
It does stay the same as well, okay? But, however, what is the depreciation expense going to be?
$2,500.
2,500. Okay. So let's take a look at this. So yes, you're noticing a trend here. Yes, the depreciation basis, you're noticing that it's going to reflect similar. They're going to be, you're going to get the same number. Your rate's also going to stay the same. However, the only difference is that your depreciation expense is actually changing because you have a variable. You're depending on the total number of units that you produced that year. So here, yeah, you notice that your first two columns are already going to be filled in. Okay? The only thing that you're actually filling in here is going to be your depreciation expense, your accumulated depreciation, and your book value. So notice this, I already went ahead and calculated it for you. I added my previous year's depreciation, accumulated depreciation, which was the 2625, plus my current depreciation expense, which is 2,500, to give me a total of 5,125. All right. And I took 5,125 and I subtracted it out of my 15,000 to get me now a new book value of 9,875. Okay. Notice this. I'm just going to go ahead and pass forward that. So as we said before, you're noticing a trend. You're noticing the first column is going to be, it's based on the total number of units that are produced that year. In general rule of thumb, this whole entire column needs to add up because you have a capacity. Okay? Your maximum that you can do is going to be producing exactly 10,000 units. No, and then you're noticing your depreciation basis and your depreciation rate or per unit rate, they're staying the same. Okay? And of course, your information here, your depreciation expense is going to change. And notice this. At the end of your useful life or your machine's life, right? At the end of its 5th year, your accumulated depreciation should equal your depreciation basis. Okay? And your salvage value or your book value should always match or be equal to your salvage value. Okay? So those are just a few little things to look out for. Now, of course, in reality, when we look at this machine, well, what if I actually produced more? What if my last year I ended up producing 200 more items? What happens here? What's my depreciation expense going to be? And what is my accumulated depreciation? And what's my book value going to hold? If my last year of this machine's life, and it decided to produce 2,200 more, what is going to be my depreciation expense and book value?
Expense is going to come out to 2,750.
Okay, and what's my book value going to hold?
Well, 250.
12. Okay, that's a pre-accumulated. 1250. Okay. It's going to be reflecting as a lowered amount, but in this case, absolutely, you cannot go beyond a capacity. Okay. So here's a rule here, because you did have 2,200. The assumption is this: those extra 200 items that you produce has a potential to be defective. Because at this point, your machine has been gone through wear and tear, right? And you can't say, its productivity level, or its when you produce the product, you can't say that it was as what it was in the very beginning of its year. You're assuming that because you didn't count, or you just end up producing extra units, right? You're subject to having a possible defective items here, because you produced way over capacity, all right? But when we depreciate, you cannot go beyond capacity. A set limit is a set limit, okay? Now, let's just say potentially you did those extra 200 items, right? They ended up being okay. They end up passing inspection, whatever, right? What happens is that is actually just going to be dissolved right into your asset itself, okay? There's no measurement for us to go ahead and go beyond the capacity. That's just what it is, okay? So just a little fun fact here. However, but in our books, we need to reflect it at capacity. So if we produced more, you cannot record it. You're just going to have to record it at 2,000. Okay. So again, and second rule here is that your book value can never, ever, ever fall below salvage value. Okay. So let's say my book value was 0, right? And so on and so forth. If I had that 2 extra 100 items produced, your book value would be a negative number. And can we have a negative number in our fixed assets? Can I say my printer is worth negative $100?
No.
Of course not. At that point, that's it. It's done for. So in this case, that's also where that concept applies as well too. Your book value can never fall below salvage value, or fall below 0. So in this case, we cannot recognize it at the 2,200. We have to go back and recognize it at capacity level. Okay. All right. Now, is that clear for everybody?
I think so.
Okay. All right. So now that we have that part right there, now let's go ahead and talk about how to journalize it. Okay. So of course, journalizing is where it's gonna is very going is I don't know how to say it. It's actually very important that you know this, because one thing that you need to do in order for it to be able to work is you are actually going to be creating a contra account. Now, let's go ahead and just go ahead and try to record it this time. So if I have my values right here, right? I have my depreciation expense. It is right here. Okay. And we know depreciation expense is going to be an adjustment entry, right? I've mentioned this before. This is only something that you record either at the end of a given month or you at the end of a given year or quarter, whatever accounting period you use. But in this case, this is one of the exceptions that you don't have to do if you're on every day. You don't do it every day. You do it every month. Okay. Same thing with the bank reconciliation. We don't do it every day. You do it at the end of the month. So, knowing this, right? How are we going to journalize this depreciation expense?
Debit depreciation expense.
Yes. Okay. What's my equal and opposite credit?
Accumulated depreciation.
Yes. Okay. So, question that a lot of students have here is, why don't I directly take it right off of my asset? Why don't I take it directly off my asset? Any guesses? Why don't I directly just take it right off my asset? I'll give you guys a hint. It's because of gap. Okay. Any guesses? Come on. Wild guess. Say that again, Milo? Because of historical value. That is correct. Because we originally purchased it at a value. You cannot change the value unless you turn around and sell that item back. Okay? So the assumption is we cannot change the value of my asset because I didn't sell it. I'm not selling it. I'm just depreciating it. So that's why we have to create a contra account called accumulated depreciation. Okay? All right. And of course, it's going to be for the 26-25. So for every year that you're currently working on, so this is important that you need to know this as well. When you do your depreciation table, it's obviously going to be there for, years. Okay? And then every year, you're going to come here and you're going to journalize it just like this. All right? And because accumulated depreciation, it's a contra account. It's going to be a contra account to your actual fixed asset. Okay? So in your books, it's going to reflect as if your asset is at current fair market value, but when you actually take a look at it, it's going to be your asset, the price that you paid for it, and accumulated depreciation, which is kind of showing you your current book value, but it doesn't take away from it. It's just another placeholder. Okay. All right. So good. Any questions in regards to how we journalize depreciation.
The accumulated depreciation count, that's not going to be one that gets closed out every year.
No,
Roll over year to year then.
that's going to roll over. Yes, because if it's a contra asset account, okay, our assets are going to be a permanent account. It always stays open. It never closes out. Only your depreciation closes out at the end of the year. Okay. So again, this is also called a non-cash transaction. There's no real cash really moving. There's no real cash actually. I'm not paying $2,625 to get rid of my, or to say that I spent my item. I already incurred the expense by buying the item. So in this case, I'm just transferring money into another placeholder. All right. So in this case, there is no real transaction, and only your depreciation is going to close out at the end of the year. Okay, your accumulated depreciation is going to hold its value until the day that your asset is completely gone. Okay, that's a good question. Any other questions?
So, depreciation is reducing the overall asset value.
Say that again.
So, accumulated depreciation is reducing the overall asset value.
Yes, yes. In your books, it does. It acts as if it is trying to decrease or adjust your asset value, but in reality, when you look at your when we do the chart of accounts, or not the chart of accounts, when we do our ledger, you're going to see, and this is an example. I'll reiterate it when we get there, when we get down to closing out our books at the end of the year, and we have to do depreciation. You're going to notice that my asset's still going to hold its value, but I'm going to have my contra account reflect it so it looks as if it appears on my books that it's at its fair market value. Okay. However, in my books, it's still going to say my asset's still $10,000. Okay. Or when I originally journalized it. Okay. Okay. So good. So again, this is just again everything that I teach in this this entire concept. It will all make sense when we piece it together when we do our class project. Okay. Any other questions in regards to this particular section here?
No.
Okay. So, yeah. So the next one is going to be, let's go ahead and practice journalizing for the second year. How am I going to journalize depreciation for the second year?
Debit depreciation expense.
Mm-hmm. Good. Good. Yes. You're going to debit your depreciation expense, and then you're going to, good. You're going to credit your accumulated for the 2,500. Okay. So again, every year this adjustment entry is necessary. And again, it depends on how often you even want to depreciate. Do you want to depreciate it every month? Do you want to depreciate it every quarter? Or even every year? Most cases, most common that you will see is either at the end of the month or at the end of the year. Okay? Okay, so we talked very, very briefly about this. Well, what happens when we talk about placing an asset in the middle of the year? What happens when we have partial years? Okay, so in this example here, on October 1st, okay, You made a purchase of a machine for $10,000. Its useful life is 5 years and a capacity of producing 25,000 units. Okay, it has a salvage value of 2,500, and it's at the end of its life. Oh, sorry, that's a weird sentence. It has a salvage value of 2,500 at the end of its life. Okay, and the machine was placed into service on October 18th. Record the depreciation for the first year if the total units of produced was 250 units. Okay, so in this case, I placed my my asset in the middle at the end of the year. Excuse me, October's at the end of the year, right? So because what is the assumption here? I placed it on October 18th. So when am I going to actually start depreciating it?
November.
You're going to start depreciating in November because it falls after the 16th, right? And the assumption here is that, that's towards the end of the month. That's not more than 50 or 75%. That's below 50%. So in this case, I don't need to depreciate it that month. I'm going to depreciate it the following month. So therefore, because we're dealing with partial years, right, the assumption that often most depreciations are taken at the end of the year, that means I can only depreciate this asset for November and December, right? Because I'm not accounting October because it's after the 15th. So in this case, I'm only counting November and December, okay? So how am I going to calculate this? If I have a total of 250 units that I produced, what's my depreciation basis? What's my per unit rate? And what's my expense going to be?
So depreciation basis. Depreciation 10,000 minus 2,500.
Mm-hmm.
7,500.
7,500, good. And what's my per unit rate?
7,500 divided by 25,000
Mm-hmm.
gives us 0.30.
Okay.
And then depreciation expense would be $75.
Okay. So there it is. That's correct. Okay. So here we have 7,500 for my depreciation basis. We have the rate of 0.30, which is 30 cents. So because I produced 250 items times 30, I have $75. Okay. Now, notice this. I don't care about the time that I placed into service because at this point, you're going to know at the end of the year how much you produced that year. So in this case, it's not time sensitive at all. Okay? I just want to throw it in there to throw you guys off. So just know that when you're dealing with partial years, it doesn't matter when you place into service because at the end of the day, what's most important is, did you reach your capacity? Okay? We don't care when you place into service because at the end of the day, at the end of every year, you're going to be reporting how many units you produced that year. So in this case, we're going to journalize it just as is. So just know that there's no need for, it's not time sensitive. It's only based on the number of units that it can produce. And on top of that, all you need to make sure that you're looking out for is a capacity. Now, The reason I mentioned it this time around is because when we move on to the next two depreciation methods, you're gonna notice that time is definitely sensitive. All right. So if you place something in the end of the year, the middle of the year, beginning of the year, it's going to matter. In this case, it doesn't even matter. Okay. Of course, and then here you go, you journalize it. So this one, because this one's based on a capacity, the other two are actually going to be truly based on the time that it has its useful life for. Okay. Any questions? So course review. We talked about the 5 components that you need to have. We talked about what depreciation is, okay? And we also talked about the rules, especially when each component, right? Each component has its own separate rules. So for example, component number 4, which is the date. It's important that you know whether it fell between the 1st or the 15th, or whether it fell on the 16th or the 30/31st. Okay. Same thing with rules number 2 and 3. You need to know which one are you going to use. Are you going to use GAAP or are you going to use sole proprietor? Okay. But in this case, for sole proprietor, you can use the information from GAAP. You can intermix and whatever you'd like, because at the end of the day, right? Only sole proprietors, they have the leniency, they have the ability to be able to determine the value of the estimated life, and they also can determine their own salvage value. All right. And then, of course, that's how you journalize it. You're going to debit depreciation expense, and you're going to credit your accumulated depreciation. And all of this is going to be an adjustment entry happens at the end of a given period. Okay. Any questions in chapter 11.1? Okay. Here are the formulas that you need to have. Okay. Any questions? Okay. All right. Little fun fact here that units of production is based on the total number of units that it can produce. Therefore, it has a capacity. So just a little reminder for you, okay? So right now it is 10:15. Let's go ahead and take a 20-minute break before we do the exercise. So let's go ahead and do that. So please be back no later than 10:35.